Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is Tuesday, February 14th, 2023. I'm filming this show a day early, and I'm still sad. Not much sleep. I was up crying, and my Eagles lost a heartbreaker last night in the Super Bowl. But I got some good news. It's Valentine's Day, so we're going to take a positive. We got some stocks coming up right now that could be some winners for your Valentine. Also breaking down the markets and how good they look right now. All this and more coming up on Making Money. One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's Nightmare Winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says, we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. That is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report we've put together about America's Nightmare Winter scenario. Get the facts for yourself. Go to www.americawarning2023.com. Get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, go to americawarning2023.com for this free report. Again, this is Matt McCall. Thanks for joining me. It is February 14th, 2023. It is Valentine's Day. And as I mentioned, we are taping this the 13th of February on Monday. And I'm down in the home office here in Baltimore. But I spent last night and the weekend up in my original hometown outside Philadelphia, watching the Super Bowl with friends I grew up with and family, and about 15 rambunctious little kids throwing the football, running around everywhere. And we had a hell of a time until the ref made a horrible call with about 1:45 left and cost the Eagles a chance to tie or win the Super Bowl. But that being said, I've matured in my older age. It was the best 2 teams in the NFL, one of the better games I've seen in a long time. It just stinks that the zebra had to ruin the game for us at the end. It ended that way. But it was a great game, and congrats to the Kansas City Chiefs on a great season. And congrats to my Philadelphia Eagles on what I believe was even a better season and a future MVP in Jalen Hurts. So get that out of the way. But I want to take a look at the markets here because we're about midday here on Monday, as I mentioned, taping a little bit earlier. Here's the S&P 500, folks. And this chart looks really, really good. And I'm going to actually pull up the SPYs, which is the ETF that tracks the S&P 500, because it goes back to the beginning of 2022 where we topped out and we've come down. And we've talked about this a few times. That white line on there is a downtrend line. We've broken through it, and we've now been above that downtrend line for nearly 1 month, folks. So there is confirmation that we have broken out in the S&P 500. We also have it above both the 50-day moving average and the 200-day moving average. With the 50-day moving average crossing above the 200-day moving average. That's the red line crossing above the blue line. Longer term, typically, it's a very, very positive for the market. So there's a lot of things moving in our direction as far as bulls. And again, look at, we're near a high today on Monday. And we had a little pullback last week. And of course, the bears are coming out saying it's over, it's over. You see these guys trying to buy puts into this. Come on, that's a bit risky trying to buy puts into this right now, because the trend is showing that we've bottomed in October and we're now making higher highs and higher lows. And let me flip over here to the Nasdaq 100, which is tracked by the Qs, the QQQ ETF. Very similar. We broke above that downtrend line. We've been above it for a couple of weeks now. We're above both moving averages. We're trading near the high of session on Monday after a little bit of pullback to end last week. Things look good from a technical perspective, folks. There's no way to argue that. I was talking to one of my analysts this morning here in the office, and I did say, I said, I love the market right here. Longer term, I think there's still a lot of bargains out there. A lot of stocks came way off the lows that they hit late last year. And, I will put this out there. because we've actually run quite a bit in a lot of individual stocks, I would not be surprised if we see a bit of a pullback here, mid to late February, even to maybe early March. And because markets don't go straight up. So we could definitely have some type of pullback. We are looking to use that to add more stocks to our portfolios for subscribers. We added one about a week and a half ago. We are adding a new stock this Wednesday for subscribers to Megatrend Investor. We're going to put out a brand new stock idea for you. And I will tell you just one hint. It does come from the energy related sector. I'm not saying it's dirty energy or clean energy, but it's energy related. And boy, oh boy, when one of my analysts pitched me the stock, I read through it a lot this weekend to edit our buy recommendation. And boy, I got more and more excited about this stock. And it's a small guy, which is nice. It's a small cap company that I think is set to rock and roll in a niche business. So there are opportunities out there. We're just being selective because we want to use the charts and the pullbacks to buy into the market. As I mentioned, today's show, it is Valentine's Day. I can't say I'm the biggest fan of Valentine's Day. I'm not against it. I'm not that guy. But yeah, I will say I just think it's more of a Hallmark holiday and a reason to spend money. I don't really like chocolate. I think flowers are a waste. You buy them, they die in a week. I just don't get it. So I just can't get into the whole Valentine's Day thing. Will I go out for some good wine and some nice dinner? Absolutely. I think that's a great idea. But there's a lot of different ways to look at Valentine's Day. And every once in a while during these types of holidays, I like to dive into a couple stocks that are potentially related to that and see if they're good potential stocks to put on your watch list. So I went through a list here. I have three, four, five stocks that are quasi Valentine's Day related. And with these five stocks, we're going to analyze them. And I will say a couple of them you want to put on your watch list from very different areas. So, in no specific order, and in no way a buy or sell recommendation for education purposes only, the first stock we're going to take a look at is Match Group, MTCH. And I'm going to show you the chart here in a moment. And you think, boy, that looks terrible. So, Match Group's about a $12 billion company. And if you don't know what they own, Match.com. So, they're basically online dating services. Dating sites. They have over 45 different brands and apps that help people meet other people of all different walks of life. They get about 95% of their revenue through fees. People pay to use the app or the website. The other 5% comes from advertising. So some of the names, obviously, Match.com, Tinder, Hinged, Plenty of Fish, Meetic. I've never heard of half these things, but those are some of the big names. Excuse me, Chispa. I don't know what that means. I'm not quite sure what you're even looking for with that. Sounds like chickpeas to me, but I don't know. I mean, there's a lot of weird people out there. Who knows what the hell they're looking for? But anyway, this is basically the brand leader when it comes to dating sites, online apps, trying to help people find their significant other. Revenue in 2022, about 3.18 billion. Revenue in 2023, this year, looking for 3.4 billion. And then 2 years from now, 2025, looking for about 4.3 billion. So decent growth, not huge, but decent growth. On the bottom line, earnings per share 2022, $3.08, dropping to $2.75 a share this year, back to $3.13 next year. So pretty inconsistent, not much growth here at all. And again, revenue is growing, not bad, but you're not seeing earnings per share and the bottom line keep up with it, meaning there's probably an issue with some margins, some higher expenses and costs, which kind of bothers me a little bit. Now let's take a look at the chart, and you'll see why I don't really jump up and down when I see this. This stock going back to late 2021 was around $145 a share. Now we're down to 45. We broke 40 in December, so we've been in this clear downtrend, really haven't broken it yet. Let me zoom out and show you a little bit bigger chart here, longer term. I believe it went public back in 2015. It did. Around $15 a share, went to single digits. It was a big winner. It was back above $180 a share. So that was an 18-19 bagger at one point. But boy, we've just been in a downtrend really over the last about 18 months or so. And until that downtrend ends, folks, I just don't think you run out and get into it. Also, the really inconsistency with bottom line earnings per share growth, that concerns me a little bit as well. So again, there's no reason to really run out into the stock, but maybe you use some of these services, maybe you think they're great, and sometimes people like to invest in what they know. But again, not one I'm looking to run out to and buy at this point. Again, no specific order, but we're going to shift gears and go to Hershey's, symbol HSY. And, obviously Hershey's is chocolate, and a lot of people buy chocolate for Valentine's Day. They have about a 47% market share for the domestic chocolate market here in the United States. They have over 100 brands now. They bought up brands along the way in over 80 countries. I used to go to Hershey Park as a kid all the time. It was like school trips growing up in Pennsylvania. My niece and nephews, they go every year. They love it. They go and do the park, and they stay in the Hershey Hotel there and do all the fun stuff. It's big. It's a big draw, and it's not cheap to go there either. I remember talking to my sister about the kids going. It's not cheap, but obviously they're known for their chocolate and confections. Their revenue in 2022 $10.4 billion dollars. 2025 close to about $12 billion dollars. So again, not huge growth, but you're seeing some top line growth. Bottom line a little bit better. They had earnings per share in 2022 of $8.52. This year looking for 941 up to 1063 by 2025. So you look at it and it's not cheap, it's not high growth. That being said, when I show you the chart of Hershey's, there's something to be said about it. When a company has 47% market share of something that's not going away, trading just off a high. And again, let's zoom out and kind of see, where Hershey has been longer term. And that's one hell of a chart, folks. It's tough to argue with that. And we're going all the way back to the late 90s here. And, it's kind of odd because in 98 and 99 is on the left-hand side of the chart, Hershey sold off when everything in tech was going up because money was going in tech. And then in 2000 through 2002, when the market was getting walloped, Hershey's was actually up about 75%. And really, since then, it's just been one hell of a winner. If you bought this in 2000, you're up about 12x or so, not including dividend payouts, which pays a decent dividend. So this is one where, yeah, I'm okay adding this to my watch list for the simple fact that it's more of a core holding. It's not going to make you a huge amount of money, but it's a nice core holding in a business, again, that's not going anywhere. It's not like suddenly people are going to stop eating chocolate. Even they say it's bad for you, and obviously sugar is not good for you. Dark chocolate, they say, is good for your heart. So who the heck knows? So anyway, next one we're going to take a look at is Signet Jewelers, symbol SIG. And you may know them by their brands, Zales, K Jewelers, Sterling Jewelers, Piercing Pagoda, Jared, the commercial. He went to Jared, which I don't know if Jared's a good place to buy any diamonds or rings. Maybe it is. But they're more, I guess, middle of the road. You're not going to be getting your high-end Tiffany diamonds there or anything like that. It's not going to be that, but it's going to be probably open up to the average American. Over 2,800 stores out there. Revenue 2022 7.8 billion. This year looking, or 2025 looking for 8 billion. So only a gain of 200 million in a matter of 3 years. Again, not big growth there. Earnings per share last year $12.28. This year looking for 11.71. 2025 looking for 11.19. So we're actually going the wrong way. Sales are dropping. Earnings are dropping. That's not a really good sign. So let's take a look at the chart and see what we see. All that being said, I like the chart, but we have to take in consideration both fundamentals, technicals, and the macro picture. And the macro picture for jewelry, I don't know if I really see that. I don't know if the younger generation's into jewelry as much as the older generation was. But I'll tell you what I like in this chart. We kind of formed this big base and we broke out recently, which is a very good sign. But again, let me show you a longer term chart of Signet Jewelers. Again, known for its brands. Very choppy chart. Had a nice run in 07, then got crushed with the great financial crisis, where the company fell from $50 down to single digits. Then rallied with the market that began in early 2009, went up about 16, 17x, right back down again. Now we're all over the place. Choppy chart. I don't like that. So that's something for me that I just not running out to buy. And again, we see decelerating earnings and revenue, not a good sign either. So I got two more stocks for you. One's huge and one's very tiny. And we'll go with the big guy here first. And that's LVMH. Moet, Hennessy, Louis Vuitton. The name's so long because they have all these brands, but the name's super, super long. But the symbol is LVMUY as an ADR that trades here in the United States, meaning it's American Depository Receipt. Trades overseas. It's a European company, but you can buy it here through the ADR. Stock has just pulled back from an all-time high. You think to yourself, how in the hell are these high-end brands doing so well? Well, a big reason they have been doing so well is because during inflationary times where people tend to cut back, inflation, I hate to say this, and it's reality, so don't take it the wrong way, but wealthier people do not really get hurt by inflation as much. If gas prices go up 20, 30, 40%, it's not going to be the end of the world for them. If egg prices go up 50%, it doesn't change their life. They have more disposable income, so they're not as worried about it. So LVMUY, LVMH, they're in 6 different segments. Fashion leather goods, which is the largest and oldest part of his business. Watches and jewelry, wines and spirits, perfumes and cosmetics, and then what they call selective retailing, which includes Sephora. You've ever been to Sephora? That's bananas in there. They have a duty-free retailer in airports, and they also have other, which includes like publishing and stuff like that. Some of the brands, obviously, Louis Vuitton, Bulgari, Fendi, Givenchy, Tag, Hennessy, Moet Chandon, Glenmorangie, which is a Scotch, Sephora, you name it. Over 5,000 stores around the globe. And as I mentioned, it's a European company that's based in Paris. Revenue last year, $83 billion, looking for $106 billion in 2025. That's big growth for a company this size. The company is nearly a $500 billion company. And you do realize the gentleman who runs this company is now the richest man in the world. Earnings per share, $6.08 last year. By 2024, in just 2 years, $8.58. So that's $2.50. That's a big jump in addition onto 608. I think the numbers could even be bigger. And I think what these numbers have not taken into consideration fully yet is China reopening. This is a play on China reopening. China really was shut down for 3 years, locked down, in prison, kind of. You couldn't do anything. Who's one of the biggest buyers of high-end retail? The Chinese population. They love to buy it in China. They love to travel to Europe. They love to travel to the US and buy and spend money. This is a big deal for them. And as it reopens, you're going to see a lot of money. You remember what happened when the US shut down, locked down, and we reopened? The savings rate went to the highest level ever. The amount of money, M2, highest level ever. Money's floating around. And all of a sudden, it reopens, boom. Buying, buying, buying. You're going to see it with some of these high end. It's not just this company. There's a couple other ones out there. But if you're buying your significant other something from LVMH, they probably treat you pretty good this year because nothing's going to come cheap. I'll tell you that. So let me show you the chart here real quick, folks. As I mentioned, just broke out to a new all-time high, consolidating above 170. Look at that big volume coming in on the breakout. Things are looking good. I really, really, really like the way this company looks right now. And again, I think I'm not worried about any type of economic slowdown, any type of recession, any type of inflation coming back. I don't think a lot of stuff's going to happen. If it were, these types of companies are the ones that can really withstand it. They have what's called pricing power. They don't lower the price of a Louis Vuitton bag. Things go on sale, but they're not lowering it. They're selling it to the retailer the same price. They're not lowering it because it ruins the value of that brand. And again, China reopening is very overlooked. The last one is a smaller company. It's about a $1.7 billion company. This is a company I actually owned for myself back in the day, sold it, took a nice profit, and been out of it for a while. It's called the Beauty Health Company, a symbol SKIN, SKIN. Again, $1.7 billion company. Their flagship brand is what is called the Hydrofacial. And the reason I bought this company when it went public via SPAC a couple of years ago is because a friend of mine owns a few places that do this. And I'd go in and get my Hydrofacial. I don't just wake up looking like this, folks. It takes a little bit of work. Go get my Hydrofacial. It felt great and it's supposed to be good for you, supporting the business. But in all seriousness, I started seeing how many people are coming in for it, talking to her about the business and seeing, wow, this is a trend that's really taking off. So a $1.7 billion business in 2019, let's go back a little bit. They did $166 million in sales. And then if we take a look at 2020, it dipped to $119 million because obviously things were shut down. People weren't going in and having people touch their face. By 2021, it jumped back to 260. By 2023, we're looking for 439 million. That is huge growth. Earnings per share 2021, 4 cents. Last year, 6 cents. This year, looking for 26 cents. We're seeing big growth. Now, let me show you the chart of this. Has not done much as of late. It's come down. It's off the bottom of $9. It's at 12.42. But what I want to show you is a little bit longer term chart here. And you can see went public was a SPAC at $10. And I told you I made some money on it and ran up, hit 30. I can't remember where I bought and sold exactly, but I didn't get the bottom or top. I know that, but somewhere in that sweet spot. And then you had some bad numbers, obviously, and kind of the post-COVID rally happened, and it came down. And I think where we're sitting right now, we're back at a level that could be attractive. And if you want to buy your significant other something outside the box for Valentine's Day, Hydrofacial, I'm telling you, it's one of those spa-like treatments that keeps them looking good, and they like it. And who doesn't like going and make themselves feel and look good at the local spa or aesthetics place that they go to? But those are 5 stocks I want to share with you because, again, remember the goal of the show, folks. It's to educate. So I'm educating with 5 new stocks. It's to have fun. I hope you have fun, me making fun of myself and the Eagles and the fact that I get hydrofacials. And number 3 is to make money. And we've been doing that so far the last couple of months. We had a rough 22. I can't avoid that. I always will admit it. I'll take pride when I do good, and I still take pride when we have a bad year. And they're far and few between, to be honest with you. But the goal is to make money, and we've turned around a lot of things in the portfolio, and I think things are looking really good in the market right now. So hopefully this show helped you achieve all 3 of those things. And again, thank you so much for supporting the show. Don't forget to like, subscribe, and comment below. And coming up Thursday, one of my research assistants, Drew McConnell, is going to be joining us. We're going to be sharing what we're working on behind the scenes right now. Some really fun stuff. So don't forget to miss that show, or don't miss that show on Thursday coming up. But again, thanks for watching Foot Jokes. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.